Did you know that nearly 70% of new crypto investors lose money within their first year? It's true. While the crypto market holds massive potential, it's also full of pitfalls that can drain your wallet fast if you're not careful. In today's video, we're diving into the 5 biggest mistakes people make when investing in cryptocurrency. Whether you're just starting out or have already bought a few coins, these are critical errors you need to avoid if you want to protect your investments. Mistake 1. Jumping in without research. One of the biggest mistakes in crypto investing is jumping in with the hope of quick profits, without understanding the basics. New investors often hear success stories and get excited, thinking they can double or triple their money overnight. But here's the hard truth. Lack of knowledge is a quick path to losses. Studies show that over 60% of inexperienced crypto investors lose money because they don't fully understand what they're investing in. Cryptocurrency isn't just digital money, it's built on complex technology like blockchain, and each coin has unique purposes, risks, and market patterns. Without researching these fundamentals, investors are practically gambling. So how can you avoid this mistake? Do your homework, take time to understand the basics of blockchain technology, learn about different types of cryptocurrencies, and study how the crypto market moves. There's a lot of free information out there to help you get started. Think of it as a way to protect your investment. Ask yourself this: would you ever buy a car without knowing how it works? Crypto is no different. Knowing the essentials is your best defense against costly mistakes. Mistake 2. Falling for hype and scams. One of the biggest traps new crypto investors fall into is buying into the hype without fully understanding the risks. The crypto market is constantly buzzing with promises of the next big thing, and it's easy to get swept up in the excitement. Scam coins, pump and dump schemes, and influencers hyping up worthless tokens are all too common. Many new investors end up putting their money into projects that are either unsustainable or outright fraudulent, thinking they found a shortcut to wealth. The result? Heavy losses, often within a very short period. Let's look at a real-life example: the 2021 Squid Game token scam. This token gained massive popularity because it was linked to the global phenomenon of the Squid Game TV show. Thousands of investors poured in, hoping to see big returns as the token's price skyrocketed. But soon after, the developers pulled out all the invested funds and disappeared, leaving investors with worthless tokens. This event, known as a rug pull, wiped out millions and left many people regretting their decision to invest based on hype alone. Sadly, scams like this are more common than you'd think, and even savvy investors can be fooled if they're not careful. So, how do you avoid these traps? Start with due diligence. Before investing in any cryptocurrency, research the team behind it. Who are they? What experience do they have? Legitimate projects usually have teams with verifiable credentials and a clear mission. Check if the project has a solid purpose and a roadmap that makes sense. Look for coins with proven track records rather than those promising overnight returns. Also, avoid any investment that guarantees returns. In crypto, no returns are ever guaranteed, no matter how convincing the pitch sounds. A simple rule to remember is, if it sounds too good to be true, it probably is. Stay grounded and don't let FOMO, fear of missing out, push you into risky decisions. Taking the time to research and approach each investment carefully is the best way to protect yourself from losing money in a market full of hype and scams. Mistake 3. Lack of risk management. Critical mistake many crypto investors make is diving in without a solid risk management strategy. Crypto is one of the most volatile markets, and while it offers potential for big returns, it also brings a high chance of significant losses. Let's put this into perspective. Bitcoin and Ethereum, two of the biggest and most well-known cryptocurrencies, can experience price swings of 10 to 20% within a single day. For newer or smaller coins, the volatility can be even higher, meaning your investments can fluctuate wildly in just a few hours. Now, imagine investing all of your savings in a market where prices can swing so drastically. Without a plan in place, this volatility could lead to panic decisions, buying in when prices are high and selling when they drop, a cycle that often results in losses. That's why a clear risk management strategy is crucial for anyone investing in crypto. So, what does a good risk management approach look like? Start by setting stop-loss orders. This strategy allows you to set a specific price at which your assets will automatically sell if the value drops, preventing further losses. For example, if you buy Bitcoin at $20,000, you could set a stop loss at $18,000, ensuring you limit any potential loss. This way, you don't have to watch the market constantly, and you're protected from steep losses if prices suddenly drop. Another essential rule is to only invest a small percentage of your capital in crypto. It's tempting to go all in when you see success stories, but investing more than you're willing to lose can lead to unnecessary financial stress. Experts recommend starting with as little as 5% of your total investment portfolio, gradually increasing as you gain experience and confidence in the market. So, ask yourself, how much of your savings are you really willing to lose? Keeping a firm answer to this question can prevent you from overcommitting and help you make decisions calmly, even during sudden market drops. In the world of crypto, protecting your capital should always be as high a priority as growing it. Mistake 4. Ignoring security measures. When it comes to crypto, many investors focus on profits but overlook a crucial part of protecting their investments: security. Unfortunately, this lack of attention to security leads to countless hacking incidents and loss of funds each year. In fact, it's estimated that over $3 billion worth of cryptocurrency was stolen in 2022 alone due to hacks and security breaches. For individual investors, a single hack can wipe out an entire investment, and in many cases, these losses are permanent. So, how can you protect yourself in a space where cyber threats are constant? Start by using a hardware wallet. Unlike online wallets, hardware wallets are physical devices that store your crypto offline, making it nearly impossible for hackers to access your funds. This small investment in a hardware wallet can be a lifesaver, especially for those holding large amounts of crypto. Another essential security practice is enabling two-factor authentication on all your accounts. This adds an extra layer of protection by requiring a second form of verification when you log in, usually through a text message or an authenticator app. It might seem like a minor inconvenience, but two-factor authentication can prevent unauthorized access even if your password is compromised. One big mistake that's easy to avoid is storing large amounts of crypto on exchanges. While exchanges are convenient, they're also prime targets for hackers. Moving most of your funds off exchanges and into secure wallets reduces your exposure to these risks. Use exchanges only when you're actively trading, and otherwise keep your assets stored safely offline. Finally, if you're serious about crypto security, consider diving deeper into the topic. There are excellent online resources, like guides from reputable websites and crypto security courses, that can give you a more detailed understanding of protecting your investments. Taking these extra steps might seem like a hassle, but they're essential in an industry where security threats are always evolving. Mistake 5. Emotional trading. One of the biggest challenges for crypto investors is learning to manage emotions. The highs and lows of the market can easily trigger feelings of fear and greed, leading to impulsive decisions. When prices skyrocket, greed kicks in, and some investors buy without thinking, afraid they'll miss out on more gains. On the other hand, when prices drop sharply, fear takes over, often causing panic selling at a loss. These reactions are common but can be incredibly damaging to your long-term success. A recent example of this happened when Bitcoin saw a sharp drop from an all-time high, triggering widespread panic. Many investors, worried that the market would continue to plummet, sold their holdings at a loss. Yet, just weeks later, Bitcoin rebounded, and those who sold missed out on recovering their value. This cycle of buying high out of FOMO, fear of missing out, and selling low out of fear is one of the biggest reasons new investors struggle to make a profit. The solution? Have a plan and stick to it. Before you invest, create a clear strategy that outlines your goals and the price points at which you'll buy or sell. When you have a set plan, you're less likely to make decisions based on sudden emotions or market noise. Avoid checking prices constantly, especially during volatile times, as this only fuels anxiety. Remind yourself that crypto markets are highly volatile and short-term drops or spikes are normal. Staying calm and sticking to your plan can help you avoid costly mistakes driven by emotion. Ask yourself, have you ever felt tempted to sell everything during a crash? Learning to hold steady even when the market is turbulent is a skill that will set you apart in the world of crypto investing. Conclusion and call to action. So, to quickly recap, the 5 biggest mistakes to avoid in crypto investing are jumping in without research, falling for hype and scams, ignoring security measures, failing to manage risk, and letting emotions drive your decisions. By understanding and avoiding these pitfalls, you're already taking a major step towards smart, successful investing. If you found this helpful, make sure to like and subscribe for more insights, and let us know in the comments. Have you ever made any of these mistakes or seen others fall into them? Thanks for watching and happy investing.